Today, we're answering questions that almost every taxpayer quietly worries about. Can the IRS penalize you for losing money in business? Is making less income a red flag? Does the IRS actually see your bank accounts? And what's the smartest way to pass your home to your kids? Let's clear up the confusion. Hi, everyone. I hope you had a wonderful weekend. Thank you, first and foremost, for all of your questions that you submitted. Keep them coming. And a quick reminder, this show is for educational purposes only. It's not specific tax, legal, or investment advice. I'm a CPA, but I'm not your CPA. Before we get into the first question, a quick favor. About 96% of viewers watching right now aren't subscribed yet. If you found value from these videos and it's helping you to understand taxes a little bit more clearly, please consider subscribing. It helps the channel grow and allows me to keep creating content like this each and every week. Thank you in advance. Let's get to the first question. It's from @KUR Aesthetics. They ask, COVID was 2020. From 2020 till 2025, with increased product costs and fewer clients, the business has been at a loss. How does the IRS view the climate business owners are facing? Great question. First, let's talk about how the IRS sees this. The IRS doesn't evaluate economic climate or business hardships emotionally. They do provide tools for survival. One of those tools is something called the net operating loss, or NOL. Since your losses happened after 2020, you generally cannot carry them back to prior years for refunds, but you can carry them forward indefinitely. Think of these losses as a tax credit for your future business or future income. When your business becomes profitable again, you can use these past losses to offset up to 80% of your future taxable income. Now, here's the most important part. You want to keep receipts because the IRS enforces strict hobby loss rules. And if a business shows losses for multiple years, you must demonstrate a genuine intent to earn a profit. You want to document marketing efforts, product pivots, client acquisition attempts, operational improvements. That's the paper trail, and that's your best defense. And you've survived a historic economic period. Don't let technical rules intimidate you. Use these losses because they're designed to help you rebuild. Thank you, and great question. Question number 2 comes from @67Shell. I've been self-employed for years, window washing. I started Social Security 3 years ago and now work less each year. I'm almost 65. Will the IRS see declining income as a red flag? Great question. And the short answer is no. Declining income is due to aging or self-retirement is not a red flag. The IRS is looking for accuracy and honesty, not a specific income growth pattern. You're allowed to slow down or retire at your own pace. As long as your tax return reflects reality, meaning it matches your actual earnings, the IRS has no reason to question it. Your income story simply reflects a normal life transition. Question 3 from @JDS1791. Is it better to use a transfer on death deed for our primary residence or our child receives a stepped up basis? Great question, and very common one. A transfer on death or TOD deed is often one of the most tax efficient ways to pass a primary residence to a child. Why, you might ask? Because the property receives a step up in basis at death. That resets the starting value of the home to its fair market value at that time. If your child later sells the property, this significantly reduces potential capital gain taxes. And if your goal is simplicity and a tax efficient way to transfer this to responsible, TOD deed is often the most streamlined and cost-effective solution. Question 4 is from @DavidM8657. Does the IRS have direct access to bank accounts and financial institutions? Great question. The IRS does not have a live feed into your bank accounts, but they do have a highly efficient reporting system. And here's how it works. The first one is automated information reporting by financial institutions must send forms to both you and the IRS. Examples are things like interest income, Form 1099-INT, Form 1099-DIV, digital payments, 1099-K, cash transactions over $10,000, and currency transaction reports. If your tax return doesn't match these reports, it creates an automatic flag. Number 2 is suspicious activity monitoring. Under the Bank Secrecy Act, banks monitor unusual patterns. For example, multiple $9,000 deposits designed to avoid reporting thresholds. Banks will file suspicious activity reports called SARs, and the IRS has access to those reports. Direct access. This is the summons process. The IRS cannot casually browse your accounts. To obtain detailed bank records, they must issue a formal summons and notify you in most civil cases. You usually have the right to challenge it. And number 4 is the indirect lifestyle analysis. For example, if reported income doesn't match lifestyle spending, the IRS may investigate using indirect methods. They review things like property records, vehicle registrations, spending patterns, and statistical norms for your profession. Excellent question. Question 5 from @FastMZ3. What percentage of craft service meals for contract labor is deductible for a film or video production company? Great question. The general rule, 50% of meals costs are deductible. When food is provided on set to independent contractors, the expense must be ordinary and necessary, not lavish, business related, with company presence. 100% deduction applies only if the cost is treated as a taxable compensation or the food is part of a qualifying company event under IRC Section 274. Question 6 from @Mr. Pyrus. How do I know if my deductions are reasonable? A very common question. Deductions are generally considered reasonable if they are ordinary and necessary for your business, properly documented, and not personal expenses consistent with your industry and business size. When unsure, reference IRS Publication 535 and IRS Publication 463. And the final question comes from @JDS1791 again. Thank you for the question. How many years of tax returns should people keep? Great question. General guidelines, 3 years is a standard rule, 6 years if income was underreported by more than 25%, 7 years if worthless securities or bad debts were claimed. Great questions today. And honestly, these are issues that affect far more people than most realize. Always remember, good planning isn't about reacting or filing on time. It's about understanding the rules early so you can make smarter decisions all year long. And now it's your turn. Please leave your questions in the comments below. No question is too basic. This show is built around your real situations, and I may read yours in next week's FAQ. Thanks again for watching, and I'll see you next time. Bye.